Hello, can you hear me?
Yes, I can hear you.
Am I clear?
Yeah, you're very clear. Yeah.
Okay, yeah. But when you speak, there's still a little bit of static in it.
Okay, so what I'm gonna do is I'm gonna mute when I'm not speaking. I'm gonna mute my mic. Okay, can you hear me? Okay.
Yeah, it's like it going in and out, but it's a lot of static still.
Yeah, let me do something. Okay. How about now?
Much better.
Okay. All right.
Yep.
All right. So yeah, I think we can get started.
Sure.
All right. Yep. Ebusian forward. Yeah. Ma. Muhina kwa babiem to Era One Radio na. Mufan che. Dealing with technology. Ne. We have some glitches getting in here. Yeah. But yeah. Danyamia se. Wama kwa na yetumi asan abasubiem. I think so. It's been a while since you shared. The last time we left off, talking about bonds, we haven't had a time to meet again. Yeah, and you may know, baby, I will share if you be and I say, would you be and the other was set. So when you're quite waba era one radio, so na uni na back change my dear way, Send a can to make this, very informative and interactive, more the questions in the bar, answering those questions, it helps and it goes a long way. And questions you can call in or you can send a text message, now what in a bar, then we'll be able to answer whatever questions be no. And dog, Sam to a numeric program, and I think so the last time, we left off talking about bonds. So if we can do a little bit of recap from the last time, now enumerate, I think sir we focus more on mutual funds and CDs, which are another investment vehicles that people use. So those are the two things. So if you can give us like a little bit of a recap, then yeah, we can continue from today's discussion.
Okay, sure. Before it should be out. I know it's been a while, so definitely happy to be back. Just to recap from the last time I was up here, we were discussing bonds, right? The previous week we had discussed stocks, so now we're discussing bonds, right? And we mentioned that whenever you purchase a bond, it means that you are now, you are. It's almost like you are lending money to the particular person or company that you are buying the bond from. For example, if I want to start a company, right? I'm a brand new company. I'm trying to grow my company, but I need money to be able to grow my company, right? I can go to the bank to try to borrow a loan, or I can try to go and issue a bond, right? Like a corporate bond, right? And by doing so, let's say I come to Brother Asiem and say, hey, I want to grow my company, and I want you to kind of help me to be able to grow it. And I'm trying to look and gain some money, right? So I can issue a bond as part of my company, right? So, for example, I issued a bond to Brother Ebenezer. You know what? I need $10,000 from you, right? And in return, right? So I'm going to issue you, let's just say, a 10-year bond, and on that bond, I'm going to pay you a fixed interest rate of, let's just say, 4%. So let's just say within that 10 years, let's say maybe every 6 months you can get paid biannually. You can get paid every 6 months. You can get paid annually. It all depends on how it's structured. Each bond may be a little bit different, but mostly it's biannually, right? So I said, okay, you know what? You give me this $10,000, fixed rate 4%, and for the next 10 years, I'm going to pay you guaranteed 4% on this loan that you are giving me, right? So you are now me. I'm the borrower, and Brother Asiem is the what? Lender. right? Compared to stocks where when I buy a stock, I'm buying part ownership in the company. When I buy a bond, I am acting as a lender, giving money to the company, and the company is paying me interest for the entire time they are holding my money, right? And then when the 10 years is up, they will come along and give me my money back, right? And that's the whole idea between a bond and a stock, right? A bond, you are loaning that money as compared to a stock where you are buying ownership into a company. And whenever a company defaults, right? Think about it. Whenever a company defaults, who do you think they're going to pay faster? A stockholder or a bondholder? They are going to pay the bondholder faster because it was a loan, right, that they took from the bondholder compared to a stock where the person purchased to become part of the company. So whatever risk the company takes, that person is also taking that same risk as well. Whereas in a bond, I'm giving you my money and I'm expecting a guaranteed rate of return on a bond. Now, there are different kind of bonds that you can buy. You can buy a corporate bond. You can buy where you're buying bond from established companies, or you can buy, let's say, municipal bonds where you're buying from the county, your city, or the state, right? This is, for example, if the state wants to build a bridge, for example, right, or the county or the city wants to build a bridge, right? They can issue what? Municipal bonds. You can buy those bonds as part of your portfolio. And the great thing about municipal bonds is that what? Depending on what state you buy it from, they are tax free. So whatever gains you earn on that bond is tax free compared to a corporate bond. So sometimes you might buy, let's just say, a corporate bond paying, let's say, 8% interest, right? And you might buy, let's say, a municipal bond paying you 5% interest. And you might say, well, this thing is less. But when you account for the taxes that you're not paying on a municipal bond, right? Maybe your gains might be a little bit less or might be equal to the 8%, corporate bond. And there's a little more safety in buying a municipal bond, right? Because guess what? It is backed by the state or the county, right? Meaning that what if the state is in financial trouble? What can they do? They can raise taxes, right? So you are more protected when you buy a municipal bond compared to when you buy a corporate bond, right? Because the company, what is the company backed by? Maybe the company has a bunch of assets, but when those assets go away, you could be in trouble, right? So when you build a portfolio, you can have some corporate bonds in there, municipal bonds in there. You can have some government bonds in there, like the federal bonds. So I mean, there are different ways you can structure a portfolio with different kind of bonds. Just know that there are different kind of bonds, and they pay different rates. And also, the level of safety is very important, right? So the level of safety increase as you go from corporate to municipal to government bonds, right? Guess what? The government bond you're buying a U.S. Treasury bond. Guess what? You are backed by United States government, so guarantee I'm going to get my money no matter what, right? So the more guarantees you have in that scenario, the less interest rate you're going to be able to receive because you are trading in the safety. You want more safety, so what? You are purchasing a U.S. Treasury bond, right? And each bond you have short-term bonds, you have mid-term bonds, you have long-term bonds, right? So depending on how long or the terms of the bond, it could be considered a short-term, mid-term, or a long-term bond, right? But the key thing is you have to understand, and bonds are rated, right? When I say rated, remember I said some bonds can be very risky because think about it. If a brand new company is trying to get money to build the business, nobody really know that company. Nobody really know that business, right? So you as an investor, when you go buy that bond, right, the company's not established. There's not much known about it. So you are taking a greater risk. And because the company knows you are taking a greater risk by buying their bond, they're going to give you what? Higher interest rate. Those are called junk bonds, right? Like I said, and there are companies that raise these kind of bonds. You have AAA bonds, AA bonds, triple B bonds, right? So the AAAs are the highest rated bonds. And as you go down to the Bs and the Cs, the safety of those bonds go down and down and down. And as you can imagine, the lower the safety, the more interest rate you can earn, but you're also now accepting a greater level of risk, right? So bonds can be a very, very beautiful thing. It can be a powerful thing to add to a portfolio, right? And whenever you see somebody's portfolio, there's always a balance of stocks and a balance of bonds. And you might say, why do you have this percentage of stock and this percentage of bonds? Because why? Stocks are more volatile than bonds. Sometimes stocks can be 2 times, 3 times as more risky as bonds are. So when you're trying to create a portfolio based on what kind of investor that you can be a safe investor, you can be an aggressive investor, or you can be a moderate investor, right? So depend on your level of aggressiveness, you can have more stock in your portfolio. But if you're very conservative, you want those guaranteed interest rates, right? You want those guaranteed income payments, right? So in that scenario, you will have more bonds in your portfolio, right? The more bonds you have in your portfolio, the less volatile the portfolio is, right? But you also have to understand that the less growth you're going to have in that portfolio, because why? You are taking and you are trading in the risk for the what? The low interest rate. So you just have to know what you are trying to accept. If you're going to retirement and your focus is income, you want to buy more bonds, because why? The bonds pay a guaranteed fixed rate of interest. So you know what to expect in your retirement, right? If you're young, you're trying to build wealth fast, you want to have more stock than bond, because stocks grow faster and they earn you more than what a bond will earn you. So you just have to kind of know the differences and know what kind of investor you are, right? Both stocks and bonds have a role to play in your portfolio. It just depends on your level of risk and your level of, aggressiveness that would dictate whether you get more bonds or more stock, right? And that doesn't mean because you're older, you want more bonds. Some people who are older they are very aggressive, so they might have more stocks, right? It's all based on the individual person. But the key thing to understand here is that a stock is what you are. When you become a stockholder, you are becoming a shareholder or a part owner of whatever company you are investing in. If you buy Apple stock, you are becoming a shareholder or part owner of Apple. If Apple goes down, my friend, you might also be going down with them, because why? You are part owner, right? If you buy or purchase a bond, you are lending money to Apple, right? So Apple say, hey, because you are lending us this money, we're going to pay you this fixed percent interest rate. And one key thing to understand about bonds and stock is that they work in opposite relationship. They are inversely related, right? Meaning that when stock prices are going up, bond prices are what? Going down. Why? Because of the interest, right? Because think about it. If interest rates are high and somebody has a low fixed bond, why would anybody want to go buy that bond, right? The supply and demand economics, right, come into play. So why would I want to go buy a fixed rate bond for 4% with interest rate at 8, 10, 9, 10, 15%, right? But also, just like this, the bonds may not be as appealing when interest rates are high. When the market begins to dip and the rates are going down, the price of bonds now begin to become more what? Appealing. And they begin to become more expensive, because why? If somebody has a fixed 5% rate bond and the interest rates are, just say, around negative or 1, which would you want to have? Those what? Bonds that are fixed at that 5%, right? So you see how the bonds and stocks each have a role to play. So when you have a mix in your portfolio, it helps with your diversification of your portfolio. So without having to kind of go on and on and on, that's some of the kind of the basics of bonds, and how they work. And if you are interested in buying the bonds, at least you have an understanding of how they work and what you can expect to get out of them if you do decide to buy bonds. So that's what I wanted to add.
Thank you, Doc. I think, sir, what summarize it be no, like both sides, stocks, bonds, at least, since it's been a while since we met, and at least, say, we are new, that's a wood here, when a recap of the differences between stocks and the bonds. But there's something that you mentioned, I want to repeat that, because a lot of us, we make that mistake. When you're approaching retirement now, that's when you really need to be careful in terms of where do I put my money. I'm approaching retirement. This is not a time where I'm very aggressive on stocks. because as we mentioned earlier on, the risk over there, it's really high. Are there risk with bonds? Yes, there are risk with buying bonds. So, however, so what should the risk involved in the bonds and the stocks? Say bonds, they are not a year less. That's why when you're approaching retirement, it is best if you have the two options. Bond stocks are your only option. They are then. Our recommendation is lean more towards bonds. Okay. Until now, I am a new investor. I want to invest. I have this money. I don't even know what to do with it. I'm confused. Do I do stocks? Do I do bonds? And now I say, what do I even do? And as some of us, because I said we don't have the expertise to do that, we don't even know. Do I have a mixture of this? Do I only do this, or what do I do? I think so. The next year we want to move into the mutual funds, where maybe you don't want to just do stocks, you don't want to just do bonds, but is there a vehicle out there, Eben the opportunity to have like both worlds, yes, there is. Besides our question, yes, there is. Until they came up with something we call like the mutual funds now. And now the option for until I am more like a bucket. And in that bucket, nyoma bebre ewom. Until Doug, when we talk about mutual funds now, what is your perspective on mutual funds?
Sure, and that's a great question, right? And I think, as you beautifully mentioned, as an investor, right, you have to determine how you want to invest money, right?
Mm-hmm.
And I think the more experienced you are, the more sophisticated you can be, right?
Yeah.
But as a beginner investor, you have to be very careful, right? Don't just go ahead and just start buying the stock without fully understanding the background of that company, right? Each company has financials that you can actually research and see how that company has performed since they started to where they are now, right? So you have to do your research and really figure out and get very confident before you go and buy a particular stock of a company, right?
Mm-hmm.
So that can involve a lot more risk because, right, let's just say you take 100,000 and you put into one company, right, that you believe in so much. And what if that company goes out of business in 5 years from now? Your entire 100K is completely gone, right? So maybe in that 5 years you were making good profits, great. But when the company went out of business, your money also went out of business, right? So maybe for the particular person, that might be okay with them. They are very aggressive. They can take that chance and that risk. Everybody's different. Maybe for somebody else, even if they lose $10 on their money, they're going crazy. So for somebody like that, right, you have to be very careful that maybe you may not want to indulge necessarily in individual stocks. You may be better off investing in an overall market, which we call the S&P 500, which is the top 500 companies in the United States, right? So, for example, instead of taking this 100K and go buy one stock or buy one bond, you can buy funds, right? I mean, you can take the 100,000, you could put into, let's just say, the S&P 500. It can be a mutual fund, it can be an ETF, it can be whatever. You can take the 100,000 and you can put into a fund. And each fund is designed differently, right? It can be a tech fund where you have all tech stocks in that fund. You can buy healthcare fund, which have all healthcare companies, right? In that fund, Merck, you can have Moderna, you can have Pfizer, whatever. If that's your favorite, you can buy. Or you can buy a pool. They have the healthcare, they have consumer, they have energy, they have whatever, all in that one stock. So depending on what you're trying to do, you can buy a fund that contains many companies. Then the average mutual fund contains about 100 to 175 companies inside that one fund. So as you can imagine, your risk is significantly less because why? That same 100,000 isn't going into just one company. It's invested amongst a plethora of companies, over 100 companies, right? Now think about it. What are the odds that you're going to lose the 100,000 if you invested in all of those companies compared to just one? That's how you create diversification. So one of the benefits of having a mutual fund, or let's just say a index or whatever it is that what? Diversification. And the more diversification you have, the less volatility or the less risk you have, right? Now, some people may be experts or they may have the skill set, so they do their own trading. But in the mutual fund, it's professionally managed. You have a professional who has many years, sometimes 15, 20, 30, 40 years of experience, who's managing that money. And the idea is to be able to help you to make money. So it's a pool of money that's professionally managed to purchase assets or to purchase, let's just say, stocks, bonds, whatever it is, right? So you as an investor, the fear of investing is now taken away from you, because why? You're not making an investment decision. You have a professional money manager that's making those decisions, and the entire job every single day is to make decisions that help to be able to grow your money, because they have that experience. So number one, you have professional money management, right? And you can look at it different ways. Somebody say, well, I could do my own thing. Great. But most people cannot. That's why you have that professional money manager. Number two, you have diversification, right? That money is invested in one company, is invested among hundreds of companies, right? Number three, you have liquidity, right? Let's just say you put 100K in one stock, but then tomorrow the price of that stock drops significantly. Now it falls out of favor. To go and try to sell that stock might be very, very difficult, right? But if that money is inside a mutual fund, right, you can go and pull a portion of that money out from the companies that are doing well, right? So you have that liquidity. Does that make sense? So these are three of the best, right? And with mutual funds, any time of the day that you want to go and sell that mutual fund, they have to sell and give you that money back, right? By law. And if you liquidate a mutual fund within 34 days, you can have a check in your account, right? So there's so many benefits to a mutual fund, right? And the thing is, not all mutual funds are created equal. Some have great track records and some do not, right? Some perform poorly and some perform great. It all depends on what you're looking for, right? Some people are just major believers in technology, so they invest heavily in technology fund, right? So maybe inside that fund, you might have all the tech companies around inside that fund. Some may be small cap, some may be mid cap, some may be large cap, depending on the size of that company or how much stock they have outstanding. That dictates how much a company is worth, right? How much stock they have outstanding and the price of those stocks, or right, is what dictates the size of a company, right? So in a mutual fund, you might have small cap mutual fund, you might have mid cap or large cap. And like I said, that's just a little bit more detail you guys may need, but just understand that in a mutual fund, you are investing in a pool of what? Companies, as compared to just one company. And there's so many benefits to investing in that mutual fund. So, brother Asiem, I hope that helped out.
Oh yeah, that helps very much. Also, information about what kind, yes, very important from the beginning. No, sir. This is managed by professionals, seasoned people. They have 10, 15, 20, 30 years experience doing this for a long time. From sometimes you want to do some of these things by yourself. You want to do it, but you don't have the expertise to do it. So this is why I present you the opportunity to have a professional do it for you in a way I want to me enye. Another year the man say it gives you that diversification na ya can some from day one, no stocks, bonds. Who was annual way was our portfolio into that mutual fund, into the question now, maybe a better up and they say, okay, so if I have all this, how do I make money? You can about stocks. Stocks, how do you make money? You make money by the dividend ever. And also when the prices air cost, there is this appreciation in there. So you make money through that. It's the same thing because it said the mutual fund, that bucket, it holds stocks and the same thing, stocks now, professional now to amount, portfolio, one, you are getting your dividend. Two, if there's like any appreciation, you are also getting that you are getting two benefits right there. Now, in that bucket, you also have your bonds. So you are also getting the interest rate and also on the bonds, you are also getting your friend that same thing there. Maybe you may be say, so if I'm diversified in this way, then is there any risk? Do I stand a chance of like losing my money? Yes, as we spoke about stocks, if the company BBAC, NASA stock prices crown so cut down, you are able to what lose your money in there. It's the same thing in here, but the great tool about the mutual funds and because it said you have so many things in that bucket when you lose money here you also have some places they are doing well, so they tend to do what compensate or supplement the ones that you lose over here. Maybe war Apple wom or General Electric wom or Amazon wom near there. If Amazon is not doing well, maybe General Electric is doing well, or maybe Apple is doing well, so they kind of compensate for each other, they supplement each other. And that's the reason we've been saying about diversification, because once you do that, you are limiting your risk. But if you focus only on one thing, then definitely no. We'll lose everything that we have. The mutual funds, like we said, it's you are getting benefit of both worlds. Your stocks, your bonds in one bucket, and not only that, but the companies now, and what's I didn't know is so huge. Said once some of them will do well, some of them wouldn't, and you get a benefit of both worlds. And that's where mutual fund. Doug, meaning say if you have like any other information you want to add on to it, if not, we can just summarize also like the CD part of it, and people at least will have people will know. Say not just stocks, not just bonds, not just mutual funds, but at least there are also some safe investment vehicle out there. Per risk, we can maybe explore and also do the same thing.
Yeah, sure. I mean, I think a lot of times when we discuss these topics, right, it's good that we don't go too much into detail because it's going to confuse a lot of people. Because when it comes to investing, the detail is really on more sort of one-on-one sessions, right? But just in the general conversation, just understand that mutual funds have a lot of great benefits, but also understand that there's nothing guaranteed in this life, right? Just like the price of a stock can go up and go down, a mutual fund can go up and can go down, right? But the great benefit is that the companies inside that fund, maybe some are going up, some are going down, some are remaining the same, right? So it gives you that peace of mind in a diversity, right? You could buy a bond mutual fund where it just a bunch of bonds. You can have long-term bonds, you can have municipal bonds, corporate bonds, government bonds, inflation rescue bonds. I mean, there's so many things you could buy in that one bond fund, right? As compared to buying a particular bond from a company, right? So in all, whenever you invest money, you want to be diversified, and in doing so, you limit your risk, and that's what makes mutual funds a great source or a great platform or path to invest. But it doesn't mean that it's perfect. Just like any investment, it also has its cons, because sometimes the charges that may be involved in a mutual fund might be cost more than others, right? Depend on what the mutual fund is doing. So just be mindful that when you're going to invest money in any investment, make sure you have a clear understanding of what that investment is going to do for you. But a mutual fund can be very, very powerful. There's no doubt about it. I myself have invested in mutual funds for many, many years, and I've seen beautiful, beautiful results. So I'm a huge proponent, a huge supporter of it, and it works. You just need to be patient, right? So like now we can kind of shift our focus. We have a few minutes. We kind of shift our focus to CD accounts, right?
Yeah,
So
before we go there, there's
okay.
a question over here.
Okay.
Sister Abna is asking. It says, "Is mutual fund the same? Does it work the same way as credit union works?" And yeah,
So is she asking whether she can go buy a mutual fund from a credit union, or is she saying that how I want to get clarity on that question?
yeah, because the way and also like mutual funds, the way I understand the question on mutual funds, we are talking about like in that fund you have like different companies, stocks, bonds, and there.
Yep.
And when you look at the setup of credit unions as well, credit unions, you have like a lot of people pulling their resources together to form that credit union.
Okay,
so
I see the question.
The question is asking, sir, does it work in the same, your friend is in vein?
So I wouldn't say the same, but I would say the concept of it, right? The idea of it seems similar, because a mutual fund, all this is a group of people pulling their money together. Somebody's bringing $1,000, somebody's bringing $100, somebody's bringing 100,000, somebody's bringing $50, right? So the fund manager will pull the money together and will invest in securities or assets, and everybody will get their interest or their dividends accordingly based on how much money they put in. Right? In a credit union, you have a bunch of people that are putting their money together to be able to form that credit union and invest money to be able to get returns. So the idea of that mutual fund is very similar to what a credit union, I guess, function like. But when you talk about mutual funds, you're talking about investing the money in different companies, while in a credit union, you are forming that money inside that one credit union and just giving the money out for people to be able to use it and invest. And you are getting returns back, or maybe the mortgages you give to people, the car loans, the credit cards, and so forth, right? The idea is you are still getting back interest on your money or your investment. But in the mutual fund, you are buying different companies. You might have, let's just say, Navy Fair Credit Union inside a mutual fund, Bank of America inside a mutual fund, AT&T inside a mutual fund. You might have Citibank. You might have PNC Bank inside a mutual fund, right? So you are investing in different companies, while in a credit union, you are forming a union with people's money put together and lending them out to get interest or to get return. So the idea is, at the end of the day, when you invest money, what are you expecting? You are expecting a return, right? And just like you could lose money in a mutual fund because the account went down, if you, as a credit union, if you give, let's just say, $1 million to a business owner and he defaults on that loan, you are now short $1 million, right? So even in that setting, you can also lose money as well. So the concept is similar, but just understand that there's some major differences there. So I hope that answers your question.
Yeah, definitely, and also the major difference is also in the credit union you are a member, so you become as part of like the decision making. You can be like a board member near there. Whereas in the mutual funds near there, it's the concept is a little bit different. I mean, the whole idea behind them it looks similar, but it's totally different in terms because. With a credit union, you put your money there. The money will be used
to invest,
mortgages to invest near there. But at the end of it, whatever the returns that they get back, sometimes they're not even sharing that with you. If they're getting maybe about 4 or 5% on the mortgages near we'll see that no. So $1,000 and the interest rates at the amount be a 0.025. So they are not sharing equally. You see the concept, it looks similar, but it's totally different the way we talk near there. And see, one of the things I'm saying to end up, CDs, the I'm saying, CDs, which is in the longer a certificate of deposit, where we'll call any institution be our bank with they do offer that. Credit unions will offer certificate of deposit. Or bank, any bank they also provide that for your friends or more members, and on with the CDs, sometimes they tell you, sir, a BOH, the minimum to put in there is like $250.
Yeah.
You put $250 in there, they give you a term, and the term is either 3 months, 9 months, 12 months, 24 months, or even sometimes 5 years.
Yeah.
Not yet the hold at Tusika, sir. If you are able to hold that $250 for 3 months, no way in Yisikana, ya maybe like 1% of Usikana, what the abeto hono. But the issue within that 3 months, maybe assembly sifie, I need money. Can I take the money out? Sure, you can take the money out. But I must say, if you take the money out before the maturity date now, then the interest now maybe we are promised or no. And this varies from institution to institution. I'm gonna set it like the rules or the policies regarding that. Some of them will tell you if you take the money out before the maturity date, then you lose all your interest. Sometimes you have like 9 months CD. They will tell you, look, if you pull the money out before the 9 months now, then instead of getting the full your friend is interest near the amount, you lose maybe 3 months of interest. Some of them will say you lose 1 month of interest. And some of them will be generous enough to tell you, say, okay, yeah, you can pull your money out. But the risk also are sometimes some of them will tell you, say, if you pull the money out and there's a penalty, and that penalty is losing your interest. But the issue is the amount that I have invested in that seed, am I going to lose that amount? If it's $1,000, am I going to lose any of that 1,000? And the answer will be no. You'll be guaranteed to get it back. The only thing you wouldn't get back is your interest rate. In the interest of time, it looks like say your time no aso apa unti no abusuafo we de yadamwase bebre na momfa ncha yen so for the initial your friends technical glitch na ama yen to me young go into some the details of what we wanted to do. Nti dog my name's any last words we can summarize.
No. I think, sir, the topic, we spoke of today, is very, very important, and I think we should save for next time to continue the CD talk, because that's one avenue that I see a lot of clients put their money into a CD, and sometimes they don't really understand why they're putting their money in there, and maybe they don't even know other investment options except for that CD, right? So maybe next time we talk, we can go more into detail about CD, what it is, the advantages, disadvantages, so that people can have a clear understanding of what those vehicles can do for you. So I look forward to God willing next week to be able to kind of talk about that.
All right. Yo, for for joining in today. And like we said, Doc is next week, same time, 7 p.m. 6 p.m. And our topic, will be on CDs, and we'll look at other investment vehicles that are available as we bring our investment aid to a close. Until next week, yakrama.
Okay. God bless everybody.
Okay.
All right. Bye.